Okay, so now, without further ado, I'd like to introduce our first speaker for today. Please welcome Mr. James Spenceley.
Thank you, everyone. So today I'm I'm struggling for what to present because I'm a fund manager now. So I thought I'd take you through a little bit of the way that we look at businesses and the way that we create our fund and we look at opportunities. And we are actually a small cap fund investor. So the same companies that you're seeing today to present and the same companies that you're interested in, we are investing in as our fund. So this is a perspective of a small cap fund manager, and also why you should be interested in the perspective of a small cap fund manager. So MHOR, my business, we established it in August 2016, so about 6 months ago. We specialise in small companies, so that's everything outside of the ASX 100. People define small cap as very differently, but that's our definition. The unique combination and the reason that we exist is, I built a business, Vocus Communications, which grew from $25 million market cap to ASX 100 at sort of peak at $5 billion. During that period, I went around and I saw every single small cap manager there is, and I saw them twice a year, 3 times a year. So I have a very different perspective I've sat on the other side of the table to funds managers. My partner Gary has been a fund manager for 6 years in Australia, has an excellent track record. So we've got the unique combination of a fund manager and someone who's actually built a business. So we get a unique perspective, I think, on evaluating companies and the growth that they're going to go through. So Gary's 14-year investment management, 6 years running a $1.2 billion fund here in Australia called Renaissance. He had a compound 12.7% outperformance against the Small Ordinaries Index. He's a technology specialist, certified chartered accountant, and a mechanical engineer. Gary's performance has been stellar over the years. If you'd invested $100,000 with Gary in 2010, that would be worth $220,000 based on his trade data for that 6-year period. I have no track record in funds management, so I bring the perspective of evaluating management, the teams, the journey that the fund, that the business is going to go on, how are they going to raise capital, how do they present to market, how are they getting their message across. So my background is Vocus Communications. We had a 1,600% total shareholder return in our listed period. We completed 12 acquisitions of $1.5 billion and grew to be, as I say, one of the ASX 100 during that period. So I'll talk now rather than promote myself, which is what that was. We'll promote the business. We'll talk about what we look for in small caps. The first thing we do in our process really is to look at a theme or a macro kind of tailwind, we refer to it as. We want to imagine what the world will look like in 1, 2, 5, 10, or even 20 years' time, and find businesses that will benefit from those themes. So there are always ups and downs with businesses, and especially with small cap businesses. There's smaller management teams. Things can go wrong, but if you invest in a business with a tailwind, with whether it's regulatory or product or some form of tailwind, those sort of speed bumps that you get with any business get smoothed out if you've got a strong tailwind. We want to see a quality product. It's something that people need to buy. We saw 200 companies in February, and there's so many businesses that just don't have products that really need to exist. They're nice and they're kind of clever, and you think, wow, it's a great idea, but I don't need to buy it. So we look for things that people need to buy or people will need to buy in the future. And then we look at management. For me, management is probably one of the most critical things before we make an investment decision. What are management like? Are they trustworthy? Do they know their business? Have they come from the industry, seen a problem, found a better way to do it? What's their experience? And that's pretty key. We love to find guys who've been in a big organisation, got tired of the bureaucracy, found a better way to do something, gone out and started their own business. We love that. Importantly then, before we make an investment decision, we look at the capital structure, look at the cash flows of the business. Are they going to need to raise money? What's their cash flow like? What's their debt levels like? Map out 2 years of cash flow, work out if they're going to raise money, when they're likely to do that, because we don't want to invest in a business the day before they go and raise money, or we don't want to invest in a business where they're just going to struggle to pay their debt down. And then valuation comes into it. Obviously, as we all want, we want something that's undervalued. So to give you a couple of examples, I thought this might be useful about the way that we've approached a couple of sectors. For us, childcare is a great thematic. It's a must-have service. Typically more babies are being born than childcare places are being created. So there's great supply-demand at the moment. Housing prices are increasing. That leads to more women needing to join and rejoin the workforce, again leading to more demand. The positive government subsidies, so that reduces the cost significantly. It's unpopular to take these subsidies away, which is really key. A lot of the great investments have been in aged care, and the aged care has been exploited. People have been, ultra earning, I suppose, given the government subsidies. Now that's a problem. Government takes that away. Suddenly share prices collapse. But you can't ever imagine that the government or any government would like to take away subsidies on childcare. There's a positive GDP contribution for childcare. It's proven that every woman that goes back to work actually creates more GDP than the government pays for the subsidy. And these are micro businesses, and this is important in today's Trumponomics, Trump Twitter kind of world we live in. You don't want a business that's can be blown away by a single tweet from Donald Trump. So these are micro businesses. Even, each childcare is a micro business. You might have the largest operator, let's say G8, with 500 centres, but each of those centres is a micro business. So our stock selection in those areas is G8 and Think Education. We tend to trade into and out of those as the value of them changes. Currently we're invested in Think, and we like that business a lot. So I've been through it. Population growth is really key. Female workforce participation rate and cost. How much does childcare cost? So if we look at the number of children under the age of 14, it's been growing consistently from 2011 to now, and it's predicted, and very obviously a pretty easy thing to predict, predicted to grow significantly into the future. If we look at participation rate, it's flattened here a little bit. The government's proposing to actually increase the level of subsidies from currently sort of around that 75 to 90% for low-income workers. So that should stimulate more people, and that sort of an artificial cap should go away. And if you look at, this is a really interesting one. This is the actual cost, the gold line that's going up and to the right. That's the actual cost of childcare in gross terms, and the blue line that's kind of got the sawtooth there is the net cost, so after subsidies for the childcare, versus inflation, which is kind of in the grey area there, and household income. So as you can see, it's now actually cheaper to put your kid into childcare than it was kind of 7 or 8 years ago, and at the same time you've got your wages, which is the dark blue line, going up. So an incredible strong macro theme for this industry. Next, the one we like as a theme and how we think about the world is cloud storage. Everybody's storing stuff on the cloud. The concept of putting it on your hard drive today is just gone. People are using Dropbox, Google Mail, iCloud, Amazon Compute for more, for business uses. That compute needs to live somewhere, and we think that's in the data center. So NextDC is a listed stock that we think is the pure way to play the cloud. There's other ways to play it. There are resellers of Microsoft, and they don't own the infrastructure. Microsoft might cut them out. Microsoft might grant 10 more licenses. But NextDC is the actual physical piece of infrastructure that will always be there, and people will always need to put their equipment in there. Some interesting stats. Every day we create 2.5 billion gigabytes of data. 90% of the world's data has been created in the last 2 years. We create 10 million Blu-ray discs of data. These discs, when stacked one on top of the other, is actually 4 times the height of the Eiffel Tower. That's every day. So the data isn't going away, and the most important thing is we're actually not deleting data. The concept of deleting stuff anymore is gone. So the increase in data is huge. I was really surprised to find that our Dropbox plan that we use at MHOR is $27 a month for 3 users. And this is the part that surprised me, was as much space as you need. In the standard plan, you get 2 terabytes. This is unlimited space. So the thematic for data growth is enormous. So that data has to live somewhere. Where does it live? Data centers. So these are NextDC's facilities in Melbourne. You can see the sheer size and scale of this thing. And that's literally where the cloud goes to live. Microsoft, Google, all these guys, Amazon are clients of NextDC. So that translates into earnings growth and revenue growth. This is a left-hand side chart there is the NextDC revenue line. So you can see incredibly consistent. This is a real thematic. You can see it translating through into revenue. The business started, obviously unprofitably and has grown profitable very quickly. Again, probably the earnings is actually increasing at a faster rate with the operational gearing that, it's just a data hall, right? There's not a lot of overheads every time you have a new customer. A lot of that drops to the bottom line. Lastly, and I'll speed this up a little bit because I'm probably running a little bit out of time, is eyes. Eyes are an incredible theme for us. We've got an ageing population. In the last 5 years, since 2000, the average life expectancy has gone up by 5 years. That's an amazing stat. But the interesting thing is, while we're keeping people alive longer, you can't actually while you keep yourself fitter, for example, to live longer, you can't do anything for your eyes. Your eyes deteriorate at a fixed rate. That doesn't improve at all. The amount we use TVs, computers, iPads is causing eyes to deteriorate at an even faster rate than it has historically. So we're living longer, but we're treating our eyes worse. The end result of that is, for example, in Shanghai, 80% of students in Shanghai are now short-sighted. That's a phenomenal stat. So we think there's some incredible ways to play this theme. The first one is glaucoma is a big issue. Glaucoma, and I'll rush through this a little bit. Glaucoma treatment currently is, and this is from a company called ELX that we've invested in. Currently, they install a stent in your eye to remove the pressure within the eye. I mean, it's an incredibly intrusive operation. No one likes to have stuff done to your eye. They cut your eye open, stick this stent in, you go away, and your glaucoma is fixed. ELX have a laser-based treatment to be able to fix this that basically clears the canals and opens the canals. Non-invasive, you're in and out in a day, no major operations. So this is a $400 million market product at the moment. This is a $2 million product that's just been launched by like a $100 million company based out of Adelaide. So incredibly exciting opportunity there. Macular degeneration, this is, again, with the ageing population, thematic incredible. So 12% of all people 80 plus have macular degeneration. Now, the way to treat macular degeneration is pretty scary. It's an injection into your eye every 2 weeks. And if you don't do that, your sight will deteriorate until the point of basic blindness. ELX have a solution to that with a laser. So that's every 6 months, recurring revenue, incredible solution, and improving the lives of people with macular degeneration. Visioneering is another one we like. Visioneering is IPOing. It's actually going to list 19th of March. The IPO is closed, but that will open up for trading. We talked about the short-sightedness. Myopia is short-sightedness. If you look at South Korea, 96% now of all young adults are short-sighted. These are astonishing stats. These guys, Visioneering, have a bifocal, one of the first in the world, and arguably the best, bifocal contact lens. So if you are long and short-sighted, if you're short-sighted and move to long-sighted, you can't actually wear contact lenses. Whereas with Visioneering, this is the first contact lens that people that are both have both issues can wear. So the market size just in the US alone, where the short-sighted penetration is probably only about 20 or 30%, is 3.4 billion. And then you think about China and Southeast Asia and all of these countries with much higher penetration rates with kids. It's an astonishing product. Basically, people get short-sightedness, which you can't wear contact lenses for, over the age of 40. Everyone gets it. It's just it's one of those facts. So this is an incredibly exciting business. Again, the rate of short-sightedness in the population is just increasing pretty significantly. So that's kind of the way we think about the world. We look for thematics, we look for great businesses within that, we look for strong management teams, and when all of those sort of come together, that's when we invest. And we find, typically, for us, we invest in about 30 stocks at any one point in time. And we tend to find, again, if you've got a good thematic, even when there's road bumps along the road, those thematics tend to take care of the small issues that you get with businesses along the way. So about our fund, the minimum investment is $20,000. We're benchmarked against the Small Ordinaries Index. We can hold 25 to 75% stocks. We're pretty conservative. We only invest up to 10% in any stock, and we can invest 20% in pre-IPO. We've done one pre-IPO investment, which we exited in December. We like to have a lot of flexibility, so we keep up to a 50% limit in cash. If we can't find those good ideas, if we've got a thematic but we don't have a company that we think has got good management, we don't invest. So we're not being forced, like most funds, to invest our money. We're long only, no leverage. You can join our mailing list. We've got about 1,000 people now on our mailing list. It's really simple. You go to our website and just punch in your name and email address. We publish our monthly data reports there. We also publish some thought pieces on different sectors and industries from time to time. And of course, if you want to invest, then there's a how to invest page on the website as well. It's open to retail and wholesale investors. Partners, we built with obviously big decent companies in our back end: JP Morgan, Custodian, Deloitte's. Equity trustees is our responsible entity. So look, anyway, apologies for rushing through that. It's a limited sort of amount of time, but I hope that was useful. We like to think of investing as partnering with the businesses we invest in, and really excited to see a number of really cool small businesses and small cap businesses here today. Yeah, thank you for your time. Cheers.